It is Sunday morning, January 25th, 2026. The screens are dark, the markets are closed, most of the world is resting. But if you think silver is still sitting comfortably where it left off on Friday, you are already behind the move. Because while retail investors were sleeping, while headlines were quiet, while everyone was pretending the weekend was a pause button, the real market kept trading in the shadows. The gray market, the whisper network where institutional money positions itself before the official open, just printed a price that feels impossible if you are still living in Friday against reality. Silver hit $108, not on a CNBC banner, not in a cute little pre-market watch list. It hit 108 where it matters most, in the first hints of global price discovery that will become official the moment Asia opens. And this is how Black Monday begins. Not with a siren, not with a breaking news Chiron. It begins with a gap, a brutal, silent gap, where the price jumps while the public isn't watching, and the crowd only wakes up once the damage is already done. That's the trap. Because if silver opens higher in Tokyo, Singapore, and Shanghai, the herd won't be reacting to opportunity. They'll be reacting to panic. They'll be buying because they're afraid they missed the last safe price, not because they understand what is breaking underneath the surface. Now, here's the detail you cannot ignore. This isn't just a paper move. This weekend wasn't a chart story, it was a supply chain story, and it happened in real time while you were watching normal life scroll by. Because while the financial system whispers about spot prices and resistance levels, the physical market is screaming something much louder. The biggest bullion dealers in the United States didn't just get busy. They went defensive. They slowed shipments, suspended pre-sales, slapped purchase limits on products that used to be treated like unlimited inventory, and quietly changed the rules of access. That is not normal. That is not a holiday backlog. That is not a temporary technical issue. That is a market turning into survival mode. And survival mode means one thing. The people closest to the metal don't trust that they can replace what they sell. That's how shortages begin, not with an official announcement, but with a dealer quietly turning off the buy button when demand becomes dangerous. So before the Asian Open arrives, before the first wave hits Western consciousness, I want you to understand what you're actually looking at. This isn't just silver moving, this is price discovery trying to escape the paper cage. And when that happens, Monday doesn't open like a normal Monday. Monday opens like a stress test, the kind that exposes who owns metal and who only owns a claim. Let's rewind 24 hours, because the most important story didn't happen on a trading floor. It happened on Saturday, January 24th, while most people were living a normal weekend. America's largest bullion dealers began acting like they were staring at a fire spreading through a building, not a normal surge in customer orders. And one of the clearest examples is APMEX, because when a dealer that big shifts its entire operating posture, it's never about convenience, it's about risk. Weeks ago, the company was already warning customers that demand had reached unprecedented levels, forcing operational restructuring. And that sounds harmless until you translate what it means in physical terms. When a dealer extends processing time from 1 business day to 4, that's not a small delay. That's a 400% strain increase on the same system. That's the kind of jump you see when inventory becomes unstable and the flow of product becomes uncertain. And here's the darker detail. Out of the core silver products they normally keep in constant rotation, items sold continuously for years, some simply stopped being available. Not rare collectibles, not exotic bars, basic 1-ounce rounds and standard bars that are supposed to exist everywhere because multiple mints produce them. Then the pre-sales began to vanish. And that one move tells you everything. Because pre-sales are how dealers take orders before a shipment arrives, locking in revenue while buyers wait. It's normal, it's routine. But when a dealer suspends pre-sales, what they're really saying is, we no longer trust delivery timelines. In other words, they're refusing to sell what they don't physically control. And when the largest dealer in the country starts behaving that way, you are watching confidence collapse from the inside. Now, pause with me for a second, because this is exactly the kind of ground-level signal you will not get from mainstream financial media until the move is over. If you want this level of investigation to keep coming, hit the like button and subscribe right now. Seriously. It tells the algorithm this matters, and it keeps this channel alive while the big networks sleep through the story. And if you're already subscribed, thank you, because you are the reason we can keep tracking what is happening before it becomes official. And it didn't stop there. Dealers raised buyback minimums, numbers like a $10,000 threshold before they even want to talk to you. Think about what that means. When a dealer raises the minimum amount they're willing to buy back, it isn't because they suddenly hate small orders. It's because they're trying to manage flow and conserve inventory. They're tightening the pipes. They're controlling what leaves the building and what enters it because they don't know how replaceable the supply will be in the coming days. So let me ask you something, because I want this documented in real time. Have you tried buying physical silver in the last 48 hours? Did you see the same delays, purchase limits, or sudden out-of-stock banners? drop what you experienced in the comments. Because when enough people report the same reality, it stops being rumor and becomes evidence. By the time you zoom out and compare dealers side by side, the pattern becomes impossible to ignore. JM Bullion wasn't just running behind. Reports started flooding online describing orders stuck in limbo, labels created, tracking frozen, days passing with nothing moving. And while individual customer stories can be messy, the official numbers tell the same story. Fulfillment windows stretching toward 15 business days. That's not a minor delay, that's weeks. That's the difference between buying metal and signing up for a future delivery contract you can TT control. And SD Bullion followed the same defensive playbook. Purchase limits, product warnings, delivery dates that slide further into the horizon the moment demand spikes. When dealers begin quoting availability months out, you have crossed a line that most investors don't recognize until it's too late. Because at that point, the price you were out of seeing is no longer a price for immediate ownership. It is a price for a promise. And promises fail under stress. Then the premiums did what premiums always do when reality breaks through the paper market. In normal conditions, large bars trade just slightly above spot. That's the dealer margin. It's stable, it's boring. But when fear enters the system, premiums don't climb gently, they explode. Suddenly you're seeing $4, $6, even $8 over spot, sometimes more, for delivery weeks away. That isn't a business adjusting its profit margin. That is a market pricing in scarcity. That is the physical world screaming that the spot price is no longer the full truth. And it isn't just America. Across Canada, inventory screens went cold. Major mint products showed out of stock. Bank supply tightened. The same warning signs echoed across borders. And when the three largest dealers in a region all pull the same defensive levers at the same time, pre-sale suspensions, shipping delays, purchase limits, buyback thresholds, it stops being coincidence. It becomes coordination born from shared danger. They're reacting to the same problem. They're staring at the same missing metal. So here's the verdict. Dealers didn't just slow down. They signaled a breakdown in the ability to supply retail demand at anything resembling normal conditions, which means the Monday price action isn't just going to be a reaction to charts. It will be a reaction to access. And access is what creates real panic. Now, layer on a second force, one that the Friday close did not fully account for. Chile, the Antofagasta region, the supply chain disruption that industrial buyers care about more than any headline. Because what's happening there isn't theoretical, it's physical. Routes blockaded, shift changes delayed, supplies disrupted. And when a mine can't rotate people and fuel, production doesn't politely slow down. It risks stopping. The world's biggest copper operations have faced strikes before. And history matters here because history teaches you how quickly companies invoke force majeure when deliveries are threatened. Silence, in this context, is not comfort. Silence is the kind of calm you get right before an official notice drops at the worst possible time, during Asian trading hours, while Western markets sleep, when momentum is easiest to ignite. And remember this, copper isn't just copper. Silver is a byproduct flow in major base metal operations. When you disrupt a meaningful chunk of global copper production, you don't just stress copper supply. You stress silver supply, too. And in a market already running deficits year after year, a disruption isn't a headline, it's a multiplier. It turns tightness into urgency. So now you have it, a retail supply chain cracking, industrial flows under threat, and the global market seconds away from reopening the pressure valve. And then there's the third catalyst, the one that turns a metal move into an institutional event. A major Wall Street bank finally said the quiet part out loud. A research note circulated through money management offices this weekend, carrying a forecast that changes behavior even before it becomes reality. Bank of America's chief investment strategist, Michael Hartnett, put a number on the table that no major bank wants to be first to say $6,000 gold by spring 2026. Not someday, not in a decade, in months. Whether you agree with the exact target or not, the real power of that note isn't the number. It's what it tells institutional investors to do next. It argues that portfolios are structurally underweight precious metals. It points to central banks already shifting reserves. It frames gold not as a trade, but as a reallocation, an optimization problem where the correct position is far bigger than what most institutions currently hold. And when giant pools of capital decide they need to reposition, they don't do it emotionally. They do it mechanically. They implement flows, tranches, allocations, mandates. Now here's where silver becomes dangerous. Silver is smaller, faster, more volatile. A higher beta expression of the same fear trade. That's why it moves harder. That's why it snaps. And that's why it doesn't take much institutional interest to overwhelm the available supply. Gold is deep. Silver is tight. A small percentage shift can move silver like a storm front hitting a fragile coastline. And the positioning data adds gasoline. Hedge funds were underweight silver. Net long exposure sat near multi-year lows even as price momentum built. That kind of setup creates what traders call forced buying. Because when price breaks higher and the crowd realizes the trade is real, the underpositioned money has no choice. They don't buy because they want to. They buy because they must. They chase to avoid being left behind. And every buy becomes fuel for the next buy. Now we have to address the rumor making the rounds this weekend, because it EUS circulating for a reason. The Tesla angle. The idea that a major industrial buyer might attempt an emergency off-market procurement to secure physical supply. Let me be very clear. There is no confirmed reporting from major outlets proving that Tesla is placing a panic order on Monday morning. Industrial giants normally operate with long-term contracts, not weekend desperation. But rumors like this don't spread in a vacuum. They spread when the system feels fragile enough that the idea becomes plausible. And the larger truth is undeniable. Industrial anxiety is real. Export restrictions, strategic resource reclassifications, premiums widening in Asia. Manufacturers competing for the same metal retail investors want to stack. When the physical market tightens, industrial demand doesn't politely step aside. It escalates. And if even one major buyer decides to break ranks and secure supply aggressively, it can trigger copycats across sectors that cannot afford disruption. So here is the deep question I want you to think about, and I want you to answer it honestly in the comments, because your answer reveals how you see the world. If silver is entering a phase where access matters more than price, what do you trust more? The number on a screen, or the ability to take delivery when everyone else is panicking? Because that's the core of this entire story. It's not a prediction game, it's a credibility game. Markets run on trust until they don't. And when trust breaks, the official price becomes a reference point, not a reality. That's when the real market moves somewhere else, into premiums, delays, rationing, and hidden transactions that most people only learn about after they've already lost their place in line. Now stack the three forces together: dealer defenses, supply chain disruption, institutional reallocation pressure, and tell me this doesn't feel like the kind of Monday that changes narratives. So now we arrive at the edge of the event. In less than 12 hours, Asia opens the gate. Tokyo, Singapore, Shanghai. And the first real test begins. Does the market validate the gray print, or does it reject it? Because if silver truly touched $108 before the official open, the next phase isn't about whether it can go higher. It's about whether the system can absorb the demand without breaking further. Watch the London handoff. If physical premiums widen sharply versus futures, that's your confirmation that dislocation is accelerating. Watch for backwardation signals, when the market pays more for immediate metal than future metal because it can't wait. Watch for sudden announcements from Chile, corporate alerts, legal force majeure language. These things don't move markets because they're dramatic. They move markets because they change delivery math. And here's the trap for retail investors. Even if spot hits a new high, retail buyers won't be buying at spot. They'll be buying at spot plus panic premiums plus delays. That means they repaying an inflated price for access to metal they might not receive for weeks, sometimes months. That's a hidden risk that doesn't show up on a chart. Because if price corrects after the spike, if volatility whipsaws back toward $19 to $85, those buyers aren't stuck to just down on paper. They're stuck waiting for delivery at what could become the worst possible moment. Then there's the futures market risk that nobody wants to talk about when prices are flying. Registered inventory, delivery pressure, open interest versus deliverable supply. If delivery demands surge into a system with limited registered metal, the exchange always has a final option: cash settlement mechanisms. And that's where the psychological betrayal happens. People don't buy futures because they want dollars. They buy futures because they believe they can take metal. If the system starts paying people in cash instead of delivering silver, what you lose isn't just a contract, you lose trust. And once trust is gone, price discovery stops behaving like a normal market. So here is my warning as we step into Black Monday: do not confuse movement with safety. A gap up can be opportunity for the positioned, and a trap for the late. The herd will wake up and chase the open because they'll feel like the last train is leaving the station. But the professionals know something the crowd refuses to accept. The first move is often the most emotional. The second move is often where the real money makes decisions. Let the panic show itself. Let the market breathe. Let the structure reveal whether this is a sustained repricing or a violent squeeze that needs to unwind before it climbs again. And I want to hear your instincts, because this is the kind of moment that exposes conviction versus fear. If silver opens above $108 and pushes toward $115, are you buying because you believe the system is breaking? Or are you selling because you believe this is the top of a blow-off move? Comment your answer and tell me why. No slogans? Give me your reasoning. Because this is the eye of the storm. The markets are closed, the world is resting, but the financial system is not resting. It's shifting, it's cracking. It's repricing reality while most people are still living in yesterday's numbers. And when you wake up tomorrow and see the gap, remember this: The move didn't start when the market opened. The move started while you were asleep. So if you want to track this timeline with us as it happens, before the narrative gets rewritten by the mainstream, subscribe right now and turn on notifications. This week won't be explained correctly until it's already over. But you're here right now at the edge of it. Welcome to Black Monday.